talk about is Fund 3. And I'll just, for those of you who may not be familiar with how a closed-end capital fund works, you commit to the fund, which means that you pledge a certain dollar amount, but we don't take that money right away. You're hiring us to build you a portfolio of real estate, and that takes time. And the way it works is that everybody becomes a pro rata owner in the fund. So for example, if we have 100 people all put $1 million in to the fund, we'd have a $100 million fund, and everybody would be a pro rata owner of 1%. If we go out and find a deal that costs $10 million, then we call 1% or $100,000 from everybody, and they have a 1% ownership in that particular deal. And so as we find opportunities out there and we are able to close on them, we call that capital from our investors, and we build that portfolio. And that portfolio construction will take about 12 to 24 months, we estimate. Distributions are also sent back same way, pro rata, based on how much you've committed. So as we sell assets, as we refinance assets, and as cash flow is created from the assets, that is sent back to investors based on pro rata. Now, the advantage of being an equity investor in a fund, there are tax advantages. Equity, you get shield depreciation, and then long-term capital gains. So generally, if you're in the highest income bracket, your overall tax rate is going to be about 25% because your income is going to be shielded. Now, our investments are IRA eligible. You can invest through your IRA, and we can talk through that if necessary, kind of offline. My partner and I are committing $10 million to the fund, and the minimum investment in this fund is $100,000. Keep in mind that your capital will be spread across 15 investments, so at a minimum $100,000, you will have about $7,000 to $8,000 of exposure per investment. Our average investment today is about $500,000 in the fund. There is a fee break at that level that I'll talk about a little bit, but we have investors at $100,000. We have investors at $10 million in our fund besides us. So let me jump. The waterfall, the way it works in our fund structure is that an investor receives a 9% preferred return, and you can think about that as an interest rate, but it's not guaranteed. When we sell, refinance, or send back cash flow, before we participate in any profits, we have to pay off the entire capital account. And the capital account includes that 9% preferred return, and then we have to send back all invested capital, and then only then do we participate on the back end of the project. The easiest way to think about this is we get 20% of profits so long as we do our job. If we only return a 9% annualized IRR to investors, then we make nothing on the back end. The front end fees, we charge a 3% upfront fee to investors. We have a 1.5% annual fee on invested equity, and then 20% of profits above that with a catch-up, and there's some nuances about that. But again, for accounts above $500,000, there is a fee break on that front-end fee. It's only 1.5%. And I do, fund structures a lot of times are compared to individual deals, and there's a lot of terminology that really has to be equalized to one another in this business, and where we don't take any other fees. We don't take acquisition fees, we don't take disposition fees, refinance fees, no fees. The fees that I'm talking about are all that we charge. In a deal-by-deal structure, if somebody has an acquisition fee, and we've talked to many of our investors about this, of 1.5%, 1.5% on an acquisition fee is not on equity. It is on the entire deal size. So if an asset is capitalized at a 2-to-1 debt to equity ratio, that becomes a 4.5% fee on equity. And even if a 1% acquisition fee is still a 3% fee. So we really have to, when we're talking about fees, we have to equalize them across funds and individual deals. So we are definitely at the low end of the fee structure. We are not a low-cost provider by any means. We have a very high-quality team who we've attracted and who we need to pay to execute our strategy.
My name is Tom Briney. I've been with Origin for about 6.5, 7 years, and I've been investing in commercial real estate at an institutional level for a little over 11 years. I'm responsible for deal sourcing and acquisitions in both Denver and Chicago. First deal I'd like to talk about a little bit is Trinity Place. It's a 115,000 square foot Class A office building located in the West Raleigh submarket in North Carolina. This acquisition was a little bit unusual for us in that it was 100% occupied at acquisition. It really required very little capital for us to maintain the quality of asset that we were acquiring. The reason we liked it and we decided to invest in it is because of the proven demand both in the submarket and in this asset. If you look at the average occupancy in this building since it was built in 2000, over the past 16 years, the average occupancy was 94%. On top of that, in 2008 and 2009, in the heart of the downturn, occupancy was 97%. That really speaks volumes to both the asset, the location, and the quality of the tenants that are inside the property. They're all financially sound and strong and had the wherewithal to survive the downturn when a lot of companies didn't have that ability to do. Additionally, the property is generating tremendous cash flow. Year one dividend is expected to be about 16% based on the contractual cash that's in place today and at acquisition. And then over our 6-year anticipated hold, we're still generating a double-digit cash dividend to investors. That's extremely unusual, and we found that very attractive. So the bottom line for this particular deal is we feel like there's very little risk being taken for the outsized returns that we're generating. Let's jump to Cherry Creek for a minute, which is located in Glendale, Colorado, just outside of Denver. It's an extremely infill market with a tremendous amount of amenities nearby, including shopping, retail, and outdoor amenities. This was a deal, as Michael mentioned earlier, that we had spent about 16 months trying to acquire and making sure that we had the pricing and the structure just right. And the reason it took that long, in addition to trying to make sure everything was just right, is that it was an off-market transaction. There were no other parties trying to bid on this, and we were able to achieve exceptional pricing as a result. To put that in perspective, the price that we paid for this building was between 30 and 40% below where the competitive properties have traded in the past 12 months or so. In addition, it's about 65% below what it would cost to replace the same building today. So when you start off with a low basis like that, it gives you a tremendous amount of flexibility to be successful with your investment. The reason it struggled early on, and the reason we had the opportunity to invest in this deal, is because, as Michael mentioned earlier as well, it was really struggling with a lack of cash from the current investors. They didn't have the ability to put in the cash, and therefore they fell behind from a market and a leasing perspective. So we're coming in with operational expertise as well as fresh capital. And we believe that with this fresh capital, we'll be able to increase our rents to where the market's at today or perhaps exceed it. And looking at the competitive set, we believe that our in-place rents are more than 20% below where the competitive set is at. So once we've invested the capital, the additional capital into the building, and we've executed our operational expertise, we should be able to push rents in excess of 20%. This is more the bread and butter of what Origin invests in. And as Matt will tell you here in a minute, we see a lot of deals that fit this profile, and we invest in a few of them that make a lot of sense. And so with that, I'll let Matt talk about a couple of different opportunities and tell you about himself.
Thanks, Tom. My name is Matt Ozzie. I'm a Vice President of Acquisitions. I'm located in Dallas, and I'm responsible for Origin's acquisition activities in Texas. The first opportunity that I want to discuss today is the AMLI Medical Center. The AMLI Medical Center is a Class B multifamily asset located in Houston, Texas. It was originally built in 2000 and comprised of 334 individual units. And, you know, the first thing I really want to address here is anytime that anybody mentions Houston, the first reaction is, and thought process, is the energy business. And to be honest, that's really no different for the majority of real estate companies that are out there today. But I want to tell you a little bit why we think they're wrong and why we view this opportunity a little bit different. First, since a lot of our competitors are unwilling to spend any more time sourcing new acquisitions in Houston, we were able to acquire this asset at a discount to where it would have traded 2 years ago. And while we love buying right, it allows us to implement our value add program at a very competitive rate. The most and greatest competitive advantage for this asset is really the location. The location is the asset's located in the Texas Medical Center, and for those who don't know, the Texas Medical Center is the world's largest medical complex. Employs over 100,000 people, and not only is it the largest, it's currently expanding with over $3 billion earmarked for expansions and renovations. And the reason why this is important and why it relates to our asset is, this asset is at the doorstep and in the medical complex with a high walkability, and it will continue to provide high demand from renters wanting to live near where they work or study. For context, over half of our renters at acquisition were employed or were studying at the Texas Medical Center, and roughly only 5% of our residents were tied to the energy business at all. So it's very well insulated from any ups and downs that the energy business may have now or in the future. And we actually believe and foresee that being the case through our hold period. The last thing I really want to touch on this asset is, due to the increased land prices and the new city design requirements from Houston, this type of property will not be replicated in this location. And so we're able to provide a unique setting for our current residents as well as future residents, which will help provide high demand going forward. Moving on, the next asset I'd like to talk about is Lee Park Towers. Lee Park Towers 1 and 2 are Class B office complex comprised of 2 buildings that make up about 120,000 square feet. The first asset was built in the 60s, and then the second asset was built shortly after in the early 70s. This opportunity is one we're very excited about, mainly because this is the best located office value-add opportunity I have seen in Dallas in the past 2 years. And the reason why the location is great, it's located in the Turtle Creek Uptown submarket. For those who are familiar with Dallas, I mean, it is the premier work, live, play submarket in all of Dallas and Texas. And, we were able to source this acquisition off market. And the reason why is we had extensive knowledge about the previous ownership's personal situation. The previous ownership was comprised of approximately 20 different oil and gas professionals who had been unwilling to spend the necessary capital to upkeep an institutional quality product for the last 2 years. And then they arrived at a situation where they needed to sell to improve their own liquidity. And so, due to their need, and over a 6-month period, we were able to negotiate an acquisition price that was approximately what the land value would sell alone at today. And to get an idea on that is, we believed we had a good asset, and when it went to be, appraised from a third-party vendor, the asset actually appraised for more than $3 million what we have it under, what we paid for it. And so the reason why it's so important is that allows us to implement our value add program, which you've heard Tom and Michael speak about previously. So for this asset, we're going to spend over $3 million to renovate and increase the overall appeal of the property. And even though we're spending $3 million, we're able to still provide some of the lowest rents in this premier submarket, which gives us a huge competitive advantage for prospective tenants when Dallas is seeing all-time highs in rents. And just for some context here, we closed on this acquisition on August 31st, and our returns that you see in the slide here of 17% assume $26 pro forma rents. And since acquisition, we've actually already signed and executed a new lease at $35 per square foot and have multiple other offers that we're negotiating at $28 per square foot. So we believe we underwrote this conservatively and will possibly outperform our projections.
It's simple: buy, fix, sell. We are a value-add buyer of multifamily and office. We operate in 8 cities throughout the United States. Our fund is really ideal for individuals who want to allocate a portion of their portfolio and outsource the management and the day-to-day. And we are the ones that make the asset selection decisions. We create the business plans, we execute the business plans, manage the risk around the portfolio, and really we define the portfolio construction process for each and every fund. Our goal is to double our investors' capital over a 6 to 8 year period in the fund. Every deal that we underwrite tends to have a 4 to 6 year business plan that we're looking to double the capital within each deal. We target a 16 to 18% IRR in Fund 3. That's what we're targeting. That was the same target in Fund 1 and Fund 2, and we outperformed both those substantially, and I'll talk about that a little bit when we get into the track record. Our typical assets that we look for, we're looking for high quality real estate that is performing well below its peer group, and more importantly, priced well below its peer group. So we're looking for deals that have edge, where we can buy them right, and where we can also create value. And we're, the 8 high growth cities that we're in include Chicago, it includes Denver, Dallas, Austin, Houston, and then in the Southeast, we're in Raleigh, we're in Charlotte, and we're in Atlanta. And the 3 themes that we look for in every deal, and this is really characterized throughout our portfolio, are individuals who own an institutional asset but don't have the scale or the acumen to run it properly. Those are kind of some of our favorite, and we'll talk about a few of those deals that we have in the pipeline. We can talk about those, or the 4 deals, these come up as well. And then we also find institutions that really have orphan assets, as we call them, on their books. So an institution, an example would be an asset that we bought from Equity Office about 3 years ago. Equity Office is a great operator, but through an acquisition, they ended up acquiring a host of smaller assets, $25 million assets, and that company is really built to run assets greater than $150 million. So we're looking for those assets that have been neglected, that have been ignored by their owners, that should be operating at a much higher level, and we come in, buy them, fix them, maximize the value, and then ultimately generate investment returns when we sell them. The last strategy we look for, or the last kind of theme, is undercapitalized owners. And Matt is going to talk about Lee Park Towers down in Dallas, one of the assets that we've acquired, and that is a great example of an owner who's more than qualified to own this, but who ran out of capital and just cannot execute the business plan. So the building has really been neglected for not because of lack of expertise, but because of lack of capital being able to put into the building. So we have 4 offices throughout the United States. We're in Chicago, we're in Denver, we are in Dallas, and we are in Charlotte. And those cities all serve as regional hubs for sourcing. Part of our strategy is about seeing every deal on market and off market. Real estate is local. You have to know it block by block. You have to have the relationships in the market as well. This is still a people business. When we're trying to generate above market returns, we want to be the first one being called, and that's why we put people in our neighborhoods and in the regions where we're sourcing deals. The track record is encompassing of Fund 1 and Fund 2. Across those 2 funds, we've acquired 28 deals. 96% of our investments have outperformed our initial projections on both an IRR and a multiple basis. We tend to be conservative, as some might say. I like to say that we're realistic about the world, and we adhere to institutional underwriting standards, and that has benefited our Fund 1, our Fund 2 investors quite a bit, and us as well. And institutional underwriting standards are simply, for those things that we don't know, we assume worst case. We don't know where interest rates are going in the next 2 or 3 years, so we underwrite higher interest rates in the future, and that's very easy to do because there's something called the LIBOR curve out there that we write into every deal. We don't know where cap rates are going to be in 3 or 4 years, so we underwrite higher cap rates on an exit price than where they are today. So as we look at the world and where the risk is, we want to make sure that we're covered, so if things start to move against us, that we're still going to be able to meet our projections. And certainly those underwriting standards have benefited Fund 1 and Fund 2 investors quite a bit, because as we were underwriting assets in 2011, 12, and 13, and assuming higher cap rates in 2016, that certainly didn't come to fruition. So we were able to generate much higher returns than what we initially projected. Fund 1 is on track to achieve north of a 25% net IRR and a 2.2 multiple to our investors, and that's a net multiple. That's after all fees are considered. And Fund 2 is on track to achieve north of a 20% net IRR and a 2.1 multiple on equity. That performance in those funds places us in the top 10% of fund managers and that's according to an independent database called Preqin that we subscribe to and submit all our data to. So let me move to the next slide, and this is really what we're trying to do for us and our investors, and we're trying to build wealth. And building wealth comes through the compounding effect of being in funds and deals that multiply your equity. So not necessarily IRR driven where we're in deals for 6 months or 8 months, but we want to double our capital over the hold period. And I think the one thing that we've done very, very well is doing it in a short time. So Fund 1, from beginning to end, the first capital call to when we will be out of all of our deals will be about 6 years. And in private equity, that's very, very rare. Most private equity companies, there's a very much an inherent conflict of interest that they want to build equity under management. And the way you keep equity under management is by holding deals for 6, 8, 10 years. We have smaller funds, we turn them quicker, and the impact of that is that for our Fund 1 investors who invested in Fund 2, or I'm sorry, invested in Fund 1, and then rolled those proceeds into Fund 2. So if they invested $250,000, that would have yielded about $550,000 in proceeds. Rolling that into Fund 2, and we have some of this is projected, still hasn't been realized yet through 2018, but over that 7 to 8 year period will result in about a 5.2 multiple on equity. That's what we're trying to do with our money, and that's what we're trying to do with our partners' money as well, is really create a multiplier effect, and that's how you grow and protect wealth. And we've done it with little to no losses and by protecting investors at every stage using responsible leverage throughout.